Hi everyone. In this video, I'm going to highlight 4 stocks to avoid in February. These are companies that are losing money on the bottom line and in my opinion trading at expensive valuations. So let's get right into it, starting with Rivian Automotive and Lucid Group trading at price to sales ratio of 51.33 and 16.47. Of course, Lucid was in the news recently as the Saudi Arabian investment fund wanted to, there was rumors that the Saudi Arabian investment fund wanted to buy up the rest of the stake in Lucid Group stock. The stock soared in response to that, jumping as high as 120% at one point before coming back down. That could partly explain why the valuation is as expensive as it is at 51.33. And then Rivian Automotive also trading at an expensive valuation of 16.47. The company is backed by Amazon, which also owns a stake in the company and has given it an order of at least 100,000 electric delivery vans. Lucid also has an order of at least 50,000 from its investor, the Saudi Arabian Investment Group. So the companies have sales and they have strong backers, although they are losing a lot of money on the bottom line. Lucid Group lost $1.9 billion in the trailing 12 months. Meanwhile, Rivian Automotive lost $7.5 billion in the trailing 12 months. For the reason I mentioned earlier, the companies have strong backers, strong investors with deep pockets behind them. I don't expect them to go out of business, so that's not something I'm concerned about here. They've got, especially Rivian, it's got like 13 billion in cash and equivalents, and Lucid can easily get an, oh, I shouldn't say easily, but Lucid can get an injection of capital if it needs some to ramp up production. My concern with these 2 stocks is number one, the expensive valuations, and number two, the increasing competition in the EV space. A few weeks ago, Tesla announced that it was slashing prices by as much as 20% on some of its vehicles. And then, in response to that, a couple of days ago, Ford announced that it was slashing prices on some of its electric vehicles. I wouldn't be surprised if more companies follow suit announcing price cuts. And this is already troublesome for an industry where many of the participants are not yet profitable, including Rivian and Lucid. So if Rivian and Lucid, they've got now a choice to make. Either they need to cut the prices of their products, of their cars, or they risk having a bigger gap between themselves and other EV car providers. And so when customers are shopping for an EV, they look at the price difference between a Tesla or one of the other competitors that have lowered their prices and to a Rivian and a Lucid, and they say, yeah, I know Rivian and Lucid cars are really, really nice, but do I want to pay that much more for it? And in an environment when consumer budgets are getting pinched, tech companies are laying off people by the thousands, and inflation is biting into budgets, there's risks of a recession, interest rates are going up. I'm not sure that the robust consumer demand will persist throughout 2023. So there is my concern with these 2 companies. For that reason, I would avoid them in February and just wait a little bit longer to get further along. Let's see if they, can ramp up production in an effective and efficient manner. Let's see where competition settles out. Is there going to be a heated price war? How are competitors going to respond in February, right? Wait to get some of that information. Don't buy these stocks yet. They're already expensive, so it's not like you need to fear that, oh my gosh, they're so cheap. I want to get in and buy them now before they go up again. I don't think that's the case. I think they're already expensive, and so you don't need to rush in and buy these stocks. So avoid these 2 stocks in February. Here's my next 2 stocks to avoid in February, and that is FuboTV and Skillz, trading at a price to sales ratio of 0.951 and 0.461, considerably less expensive compared to Rivian and Lucid, but also I'm more skeptical of the sales of these 2 companies because of their business model, FuboTV is losing so much money on the bottom line. And the fact that it, if you don't know FuboTV already, it's an aggregator of content and an alternative, a streaming alternative to cable TV. So it's kind of like signing up to a cable TV subscription, but over streaming instead, which is a lot more convenient. I agree. But at the same time, Fubo TV is having to pay so much for the content that it's selling to its customers that it's losing incredible amounts of money, 521 million in the trailing 12 months. So the company, in my opinion, needs to raise its prices considerably, and as investors, we need to see how customers respond after the company raises its prices to a sustainable level, to a level where it's not losing so much money on the bottom line, so that we can judge the company based on how many customers stick with them and what their revenues are, what their sales are, and what their expenses will be, and then what the profitability will look like. And so for that reason, I would avoid this stock in February. And Skillz has a different kind of problem. Skillz is also losing a lot of money on the bottom line, 386 million in the trailing 12 months. Skillz is spending near or above 100% of its revenue on sales and marketing. So whatever it brings in revenue, it's spending even more than that on sales and marketing. And this is another example of a company I would like to see make a significant change in the business model, namely reduce those sales and marketing expenses meaningfully. I would say cut them by at least 25%, maybe even 50%, so that they're well below your sales. And then as investors, we can evaluate what kind of revenue they experience, what kind of customers they retain after that overly unsustainable level of sales and marketing is reduced, right? Otherwise, the company's already experiencing decreasing revenue. And if they cut their sales and marketing, that's probably going to fall even further. But that's okay. I don't need to see revenue growth in a company, but I do need to see a sustainable business, right? Like I don't need to have revenue growth in order to invest in a company, but I do need to be confident in the business model, in the sustainability of the business model, which I'm not yet confident with these two companies. So for that reason, I want to see changes before I would touch these two. So I would say avoid these two stocks in February. All right, that's all I've got for this video. Thanks for watching. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.